Let's begin with this warning from the IMF. It just cut the global growth outlook, saying the recent bank turmoil is adding to stress from rising rates and the war in Ukraine. Should investors care?
I'm not sure they should care excessively about IMF forecasts, but they should definitely care about what is going to happen going forward. Clearly the economies around the world are pretty tenuous situation at the moment. So, the IMF's talking about Europe. I mean, we still feel that the US is heading towards recession as well, because we're seeing even the strong part of the economy, the labour market, cracks are starting to appear in the more forward-looking indicators there as well. So, from that perspective, we're not painting too rosy a picture at this stage from a growth perspective and from an equity market perspective, expecting another leg lower before we see equities bottom out.
And of course, CPI coming in hot as well, Steve. There's already a more than 70% chance of a 25 basis point hike in May after the latest payrolls. What is this data going to tell us?
Yeah, so clearly, I mean, if you look at the data, obviously the headline is going to come down. Oil prices falling to some degree has certainly helped, although obviously the OPEC move more recently will mitigate the benefits of that. But if we look at the underlying inflation rate, that's still going to be much higher than the Fed is happy with, and pretty robust still. So from that perspective, it just makes the Fed's job a lot harder. I think obviously everybody's criticised the Fed over the past 18 months because of the transitory commentary about inflation, but it is now in a very difficult situation with growth, in our view, weakening, inflation remaining pretty high, and lending standards were already tightening, obviously, in the banking sector, but we're going to see that tighten even more in the coming months, and that's going to put downward pressure on credit growth as well. So it is a very difficult job that they've got to manage. A 25 basis point hike at the next meeting looks like the most likely scenario. Our view is that then they'll be done, because by the time they meet again, we'll have enough weakness in the economy and maybe some good news on the inflation side to help them at least pause as we move into the second half of the year.